You didn't take any money out of your limited company investments, so why is the tax man knocking? Because in the world of company investing, nothing has to hit your bank account for a tax bill to quietly spawn in the background. Meet Mel. She thought she was just rearranging her limited company crypto portfolio. Bitcoin out, Ethereum in, all inside the same platform. No cash withdrawals, so no drama. Except HMRC doesn't see a harmless swap, they see a sale. The moment you swapped that Bitcoin, it was treated as a disposal, triggering a taxable event for her company. The gain is locked in, and corporation tax is due. No payout, no celebration, just a bill. And that's the first trap. Assuming tax only shows up when money lands in your account. It doesn't. It shows up when something changes hands. Swap crypto? Tax event. Switch funds? Tax event. Use assets to pay for something? Tax event. The platform might make it feel like one smooth click, but behind the scenes, it's two moves. Sell, then buy. And that sell is where the tax kicks in. Even worse, leaving the money sitting on the platform doesn't undo anything. The moment you hit swap, the clock starts ticking. Whether you reinvest it, leave it idle, or forget about it entirely, irrelevant. The tax point is already baked in. Now here's where it gets sneakier. Sometimes you don't even need a transaction. Own accumulation units in a fund. Congratulations, you might owe tax on income you never received. No payout, no notification, just a quiet line in a tax statement saying you earned this. Pay up. And if your fund leans heavily into bonds, the income might be taxed as interest, not dividends, which means it's fully taxable for your company. Same investment, different structure, completely different tax outcome. But surely your accounts would flag all this, right? Not if you're using FRS 105. Under that system, your investments just sit there frozen in time at their original cost. Your Bitcoin could triple in value, your ETFs could soar, your portfolio could be doing backflips, and your balance sheet would still look like nothing happened. No flashing lights, no warnings, just silence. Until you make a move, then suddenly years of growth collapse into one taxable moment, and you're digging through old records trying to remember what you originally paid. And yes, you will need those records. Every trade, every swap, every fee, every GBP value at the time, because when HMRC asks how you calculated that gain, Coinbase said so won't cut it. Now zoom out. If your company starts looking less like a business and more like an investment machine, there's another twist waiting. Tip into investment holding company territory, and HMRC strips away the lower corporation tax rates. Everything gets taxed at the main rate, no mercy for small profits. And when it's time to shut the company down, that nice tax relief you were counting on, business asset disposal relief, might vanish if your company isn't considered a trading business anymore. So that side hustle of letting the company invest a bit on the side, it can quietly reshape your entire tax future. None of this means investing through your company is a bad idea. It just means the rules don't care about your instincts. They don't care that it's still on the platform. They don't care that no money came out. They don't care that it was just a switch. They care about one thing. Did you dispose of an asset? If the answer is yes, the tax story has already begun, whether you noticed or not. And if you'd rather spot those moments before HMRC does, that's the kind of conversation worth having sooner rather than later.